Right. Today's Tuesday, the 18th of August. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. We got an important one for you because something big is about to happen. If you thought that the blow-up of Leopold was big or interesting, you're about to see major blow-ups, way bigger blow-ups about to come. We're going to talk about that in a minute and tie it up with what's going on in the bond market right now. But before we begin, we'll look at the heat map for the day. And yesterday we talked about the rally in chips and memories over. And indeed, today we see the chip names in memory and the AI data center infrastructure stocks going down big. Hynix down about 9%, Micron down 7%, Intel down 6.5%, AMD about 4.25%. You can see the damage here in names like AMAT and Lam and SanDisk down about 9% for the session today. And it wasn't just the chips, it was the AI data center infrastructure stocks such as Caterpillar, such as Bloom Energy down about 10%, VRT down about 7%, Vernova down about 7%. And even the utilities that are tied up with AI data center infrastructure and funding, such as Constellation Energy down about 4%, Vestra also down about 4%. What's new here is in the tug-of-war, when the memory stocks, when the AI data center infrastructure stocks go down, we see the hyperscalers going up. And yesterday we said that this is going to change, and you're more likely to see that both of them going down together. And the reason is interest rates are going up. And as interest rates go up, the ability to finance the data center build-out becomes more difficult. And it becomes more costly. And hence, we see the AI infrastructure stocks going down, along with the hyperscalers today. And of course, the most obvious case here would be Meta down about 4.5%. Now, you could say that Meta had its own court problems today, but Alphabet didn't do pretty good. It was flat. Amazon was down. Microsoft couldn't rally. And the only stock that went higher was Apple. So we're back to safety in tech, the company with the largest cash flow, and they're not burning their cash flows as of right now. And hence, if you happen to be a tech portfolio manager and you're beginning to lose faith in the AI infrastructure theme, and you're not positive that the hyperscalers will do pretty good because they're running out of cash and they have high debt on their balance sheets right now, then the only avenue would be Apple. You're going to park your money in Apple if you happen to be a tech portfolio manager, or consider some software. But assume the risk that comes with that, because not all of them went up today. We see Adobe, we see CRM, but again, all of these businesses have their own problems. They have the risk of disruption from AI, number one. And yes, you can slow down the development of AI, but you cannot prevent the development of AI. So the inevitable will happen. And if these companies don't have good moats in software, they're going to lose and their stocks will crash. Not to mention, of course, that a lot of these companies still don't make a lot of profits, and they have massive amount of debt in their balance sheets, so higher rates, not so good for some of these companies right here. So where do we invest? Where do we go as investors? And we said this numerous times before. Healthcare, energy for now. I will explain why. We'll show you the evidence on how these two sectors have been outperforming and give you more details. What captures my attention, though, in today's session is the defense contractors such as Lockheed, up about 2.25%, Northrop about 3% plus. You have Raytheon about 1.75%. What is the message here? Even the Israeli defense contractor ESLT is also going higher. I think that the insiders are beginning to position for a major escalation in the Iran war. And that's why they're betting on the defense contractors, they're betting on the energy stocks, and they're fading momentum, and they're fading interest rate sensitive stocks. Keep that in mind. We look at the maps every day and we try to dissect the psychology and the message by the market, looking at the different components of which stocks went up, which stocks went down. Yet I want to begin the conversation here with a reminder that on July 9th, we put out a video with the title of The Upcoming Price War That Will Pop the Memory Bubble. And in it, we explained the dynamics between the hyperscalers and what they're funding, Anthropic, OpenAI, etc. NVIDIA can be hybrid, of course. It is a hyperscaler and an AI data center infrastructure stock, but we talked about memory specifically here. And you can see the dynamic. Exchange of cash and the chips go to the hyperscalers. And we said that the point of strength, shall we say the tailwind for the memory components, is the pricing power. There's huge demand from deep-pocketed investors, the hyperscalers, and there is limited supply. And hence, they can command higher prices, and they have an impressive pricing power that creates massive margins for now. And that's the point of strength when it comes to the memory components. We're beginning to see cracks, though. For example, today we got the headline that Cerebras, they say they have a competitor, an AI chip that would compete with NVIDIA. So competition will show up sooner than later. And yes, this is an example that is specifically for NVIDIA, but we talked about the Chinese memory providers and how Apple, whether the government is permitting it or not, are already using Chinese-made memory chips. And hence, this dynamic and the nature of competition when we have pricing power, everybody wants to get into it in the bubble and juice it up. So if you have capacity to produce memory chips, you're going to do it. And that kind of damages the pricing power that these companies have been enjoying. What could also damage the pricing power for memory chips? I mean, if you look at the PPI, the annual change in the producer price index for electronics, components, and accessories, it's just an unbelievable jump. Prices are out of whack. And at some point when prices are out of whack, what happens? By nature, the law of supply and demand, when prices go way too high, it reduces demand and prices go down. It's equilibrium. We have universal laws. Yes, the buyers are deep-pocketed for now and they can afford it, but the higher the prices go and the more challenges these companies face, the more likely that their demand will come down, and that dents the pricing power from the memory components. The tailwind or the point of strength for the hyperscalers is future growth, so long as they continue to produce revenues and profits, a gigantic amount of cash. Investors can turn a blind eye to the level of spending and the fact that they're really taken for suckers by these price gouging companies. Investors can say that's okay, we're going to buy the hyperscalers because they can afford it. And as they invest more in AI, we see the return on investment and we see more revenue and hence more cash and the ability to keep the machine going. As time passes, we're beginning to find out that the return on investment is non-existent for now. And we have many challenges. Among them, the weakness of the consumer. When you think about it, Amazon, the majority of their revenue comes from consumer businesses, consumer spending. Meta, they depend heavily on advertising, which is again cyclical and depends on the ability of the consumer to continue to spend. Same thing with Google, aka Alphabet. Microsoft is a consumer-centric company, more in the B2B, but it still has a massive exposure to the consumer. And these companies fund NVIDIA and Anthropic and OpenAI and all of that. What do we see in the consumer spending power in the economy right now? Well, we got retail sales last week, and retail sales went down dramatically in the month of July. If you look at the University of Michigan Consumer Sentiment Survey, consumer sentiment is crashing. And hence, sooner than later, this negative feedback from the consumer will feed into, wait a minute, are we really going to see future growth at the same levels we're seeing right now, perhaps even more in Alphabet, Meta, Amazon, Microsoft, when the consumer is going weak? Well, the answer is no. And hence, the tailwinds, the bullish cases for these two sides in the tug-of-war is becoming weaker as time goes by. We talked about the headwinds, or the bearish case. And of course, for the memory components, it is demand risk. Because demand risk, if demand goes down, that means you lose the pricing power. It's all connected. What do we see right now? We see the midterm elections looming with huge backlash against data centers. The voters don't like it. The politicians who are anti-data center are the ones who are winning the elections right now. And we continue to see headlines such as from Pennsylvania governor today signing an order imposing new rules to set up AI data centers in the state. People are complaining. Now it's becoming costlier and more difficult to build these data centers. And hence, if we have a moratorium, we have a new class of politicians that pass a bill to pause the build out of data centers. What does that do to demand for these chips? If you can't build the data centers, there's no point in hoarding the equipment. And hence demand goes down, the pricing power is eliminated, and we see these stocks going down dramatically. What could also damage demand for these memory components or AI infrastructure, data center, whatever you want to call them, Caterpillar, Veranova, they're all connected. They go up together, they go down together. Bond yields. bond yields are skyrocketing across the globe. You see where the 30-year bond yield right now, it continues to go up. We're now going above 5%. Soon enough, we're going to touch 6%. The cost of raising debt is getting higher. Well, what does that do to the demand by the hyperscalers who want to raise debt to continue to finance their ability to buy memory chips and AI data center components? It becomes harder for them to do that as rates continue to go higher. And that leads us, what is the risk or the headwind for the hyperscalers? The company is spending to buy all of these components right here. The point of weakness is the cash flow burn, that you have revenues, you have profits, but you already burned through your cash flow. As you can see here, the cash flows are negative in the big three. In Alphabet, cash flow is going negative all the way down to 27. Same with Amazon and same with Meta. They're running out of cash. And the big bomb really is, it's not the fact that they're running out of cash. It's the fact that they have a lot of obligations. They're raising debt to finance the build out of data centers. And on paper, when you look at the balance sheets, it doesn't really look that bad. These companies still have massive assets, and the liabilities that they have right now, they're still manageable if you look at the balance sheets purely. And the cash flow burn, yes, it's happening right now, but it's just a first step of the series of concerns that investors will have about investing in these companies. The problem is what's hidden. You know, we remember the quote by Warren Buffett, you know who's been swimming naked when the tide goes out. And right now, we have no idea who's been swimming naked. Is it CoreWeave? Is it NVIDIA? Is it a certain financial institution? Is it Blackstone? Which one is it? Massive blowups are about to happen because if you look at these companies, so you have your capital expenditures right here in Alphabet, in Meta, and Oracle, NVIDIA, Microsoft. So that's what you see in the balance sheets. But what you don't see in the balance sheets, the off-balance sheet obligations are absolutely insane. And they've been skyrocketing 2-folds, 4-folds, in the case of Alphabet, 8-folds. Billions and billions, perhaps trillions of dollars worth of obligations as time passes by. If you look at it from this perspective, what you're looking at right now is the obligations, the liabilities that you see on the balance sheets. That's what you see. That's the tip of the iceberg. What's hidden, though, is what you see right here. Hundreds and hundreds of billions of dollars. Leases not started. The obligations over $900 billion. The purchase commitments over $1.5 trillion. Anything that goes wrong, we're going to have hundreds of billions, if not trillions, of dollars worth of blowups. So when you talk about one fund that blew up at $45 billion, that's peanuts to what's about to happen here. Another illustration for you, you can see here in Alphabet, the purchase commitments, almost $1 trillion. Leases not started, continue to go up. Meta, Microsoft, Oracle, Amazon, NVIDIA, all of them are falling into the same trap. Let me ask you something. Would you feel comfortable buying Alphabet, for example, being an investor in Alphabet right now, knowing this? Because at some point, yes, the company is producing massive revenue, and revenue growth for that matter. But would that really continue if we see the prices of oil going up, interest rates going up, consumers getting weaker? The answer is no. And you get a reduction in the pace of growth in revenue. At the same time, these obligations will not disappear. You're only going to have to face these obligations from a weaker standpoint of lower revenue growth and perhaps profitability growth. And hence, when they talk about, oh, Alphabet is cheap or NVIDIA is cheap on paper. But once you factor in the obligations you're not seeing in the balance sheets, all of a sudden the valuations are absurd. They should be going down dramatically. What happens when you have these billions and billions and trillions of dollars worth of obligations as in debt? When you have interest rates going up, it adds to the stress. It lessens the ability to raise more debt, and it makes the debt that you already have, the obligations that you already have, on balance sheets or off balance sheets, more costly. And hence, it is not a surprise that we see the CDS, the credit default swaps, even for companies that are supposed to be extremely safe, such as NVIDIA, we see these CDS 5-year rates skyrocketing as investors continue to buy this protection against defaults, not just the slippage, but defaults. Because look at the obligations. Look at all these obligations, the trillions of dollars. Of course, it's a no-brainer you have to buy default swaps, specifically as rates continue to go higher. And it gets worse, folks. I mean, you look at this illustration right here. We talked about this before in the previous video. So you have the Hyperion data center, which is, I don't know, 5 times, 10 times bigger than Manhattan. It's being built in Louisiana. It is supposed to be a Meta facility, but Meta, at least on paper, only own 20% of the data center. The rest is being financed by Blue Owl. These two companies don't own the data center itself. These two companies, Meta and Blue Owl, they own the SUV, the special vehicle, the special venture that they created. And they do these kind of things to isolate themselves from risk. So when the shit hits the fan, their risk becomes limited. At least that's what they think. So Meta, Blue Owl, they create this special venture. This special venture has another face called BigNet, I guess. That's what they call it. And bondholders raise, right? So this company right here issues bonds, and bondholders, the investors, the suckers, they pour their money into this investment scheme right here that goes to the special venture because they have the name Meta stapled on this whole scheme, this Ponzi scheme that you see right here. They think, oh, it's safe. Meta is a large company, so if we're investing in the bonds by this company right here, into the special venture, into the data center, at the end of the day, it's owned by Meta, so gotta be safe. But look at the isolations and the lines of defense that they're creating here by creating all of these fugazi companies to isolate themselves, because they know that this could be the fuck up of the century, really. And how do they make these bondholders feel better while they're getting screwed at the same time? Well, Meta is leasing the data center. Meta pays rent. That rent goes to the special venture, and it pays these bondholders for now. They feel pretty good about it. But anything that goes wrong here, Meta has its problems. It cannot really commit to building the data center anymore. The laws change, and there's a moratorium. You can't really build the data centers anymore. Something bad that happens with Blue Owl, and this whole scheme goes bust. But who's going to get hurt at the end of the day? It's the bondholders right here. And these companies think that they're isolated, that once we see a blow up here, the bondholders will pay the price, but they're going to walk out free and with less damage than the bondholders for sure. But we all know when things blow up, the financing is all tied up, and the stocks of these companies begin to get punished. As they begin to get punished, they cannot fulfill their other obligations, the off-balance sheets obligations. We begin to see the pieces of the domino falling one by one. We already have problems with Blue Owl and Blackstone and all of that. Look at the headline, Blackstone and Blue Owl. They're tapping the bond market. So these companies, Blue Owl, $400 million, they're raising from bonds to continue to finance this scheme. So they have their own financing from bondholders. They keep issuing bonds, raising debt so they continue to finance this and pay these bondholders. It's really recycling and reshuffling of the same debt back and forth, back and forth. These circular investing and financing schemes that might look complicated for you if you look at a map or an explanation like this, but at the end of the day, it comes down to a simple principle, and that principle is minimizing the risk for investors, minimizing the risk for the companies, and maximizing the risk for investors and the lenders of these schemes. So a failure of such a project in the Hyperion data center could cause massive economic damages, not just for technology companies, but the entire economy. Because we're talking about billions and billions and billions of dollars of the banks that are lending the money, that are issuing the bonds, that are tied to the bondholders. Some of them are banks, and they begin to blow up. You see the contagion in the economy. So again, I say, look, we go to Warren Buffett again. You know who's going to be swimming naked when the tide goes out. What causes the tide to go out and expose the naked swimmers? It's higher interest rates. And that's what we're seeing right now. So I say again, expect more and perhaps bigger, way bigger, massive blow-ups to come. Now, is there a place for an investor, Mav, that we can prevent damage to our portfolios from these kind of blow-ups that are about to happen that you're talking about right now? Yes, there are places that you can still invest in, and they're actually doing pretty good. Take a look, for example, at the energy sector, and we talked about this before the year even began. If you go back to the conversations and the videos from December and November of last year, I kept saying that energy is going to be the top performer in 2026, and the reason will be the Iran war. So we made that call ahead of time, and that's why we predicted that the dollar is going to go up, and gold is not going to be a good investment. And all of that came true as time progressed. And now we see that the energy sector is outperforming the S&P 500 by a mile. If you look at year to date, the S&P energy sector is up about over 40%. If you look at the S&P 500, it's just a touch above 10%. It's rolling over already. And why do we see the energy sector doing pretty good? It's not just the price of oil going up. Of course, that's a boon. That's a pretty good tailwind for these companies, but it's the fact that any increase in the price of energy, the price of oil, creates massive cash flows for these companies. So we just talked about companies raising debt, and they have massive obligations on balance sheet, off balance sheet, facing higher rates. Those are the companies you don't want to be in. Those are the companies that are about to suffer dramatically. At the same time, same market, you have companies, these energy companies, BP, Exxon, Chevron, Shell, all these companies are now paying back their debt. They're using the cash coming from higher energy prices, not just to buy back their shares or pay the investors in dividend or maybe invest in more efficiency, but they're also paying their debt down. As you can see, by 2028, they're going to reduce their debt from about a little over $150 billion for these companies right here, 5 companies, to under $100 billion. Would you like to be in the technology sector and the hyperscalers with the uncertainty and the risk, or do you want to be in companies that are paying their debt down, returning cash to investors, increasing dividends, investing in efficiency? And it's no wonder why that if we look year to date, energy's outperforming everything by a mile, 38% up for the year. Technology at number 2 about 23%, but that's fading as we speak. And the other sector that I keep hyping up is healthcare. If you look at the 3-month performance, the quarter, healthcare comes at number 1. And hence, I gave you my morning brief today. A lot of you folks say, Mav, you just talk about options trading all the time, but I just invest in stocks. Well, believe it or not, we talk about investing all the time. But what do you want to do right now as an investor? The only thing you can do is de-risk, is get the hell out of technology and go to bonds. Gold is getting a little better. And then you have energy, you have healthcare you can still invest in. So I say that so far in the morning, we see chips and hyperscalers down while we see software catching a bit. Likewise, we see dividend-paying sectors like utilities and staples also up along with healthcare and energy. I don't trust the rebound in software and dividend-paying stocks with yields surging as they are, because when you look at software, lots of debt, that is sensitive to interest rates going up. When you look at dividend-paying stocks, they compete with the rates on bonds. So if they can't really compete, if they're paying 3%, but you can get 2% risk-free, 4% risk-free in the 2-year yield, then it's a no-brainer. You don't need the dividend-paying stock, you need the bond. But when you look at healthcare, that's immune. Rates can go up all they want. You have a senior population that is growing by the day, and they need health care, they need Medicare, and the government, whether they're going to raise taxes to pay for that or they're going to print more money, either way, they have to do it. So funding secured when it comes to healthcare. Energy still has the tailwind of the Iran war, and so long as that continues, the sector will continue to do pretty good. We also highlighted the importance of crude oil 85. So if we take a look here at crude oil, we see that we are on track to play this ABC bullish breakout pattern. We have a little bit of resistance here, and I shouldn't say a little bit, it's quite a stiff resistance, to be honest with you. So you can see here at 85, sellers show up, sellers show up, sellers show up again. But boy, once you break above that number, if that happens overnight, for example, you will see an explosive move higher because the sellers will turn into buyers. Anybody who was selling at 85 will say, well, wait a minute, we're going to go back to 90. So let's buy. And the next leg becomes of higher velocity and higher volatility. It could happen pretty fast. The jump from 85 to 90. And if that happens, guess what's going to happen? You will see higher bond yields, and that's going to exacerbate the problem that we see in technology and many other sectors in the stock market right now. And that leads us to the market. So if we look at the NASDAQ futures overnight, touching the 50 days moving average support, but if you lose it, you still have more downside to come. My target would be 28,500 for a pullback. And of course, a lot of that depends on what's going on with the Korean market, the Kospi. The daily chart, we see that the Kospi is gapping down about 6%. So the weakness is here. And if you look at the mechanics, you look at the SPY, if you look at the SPY, the gamma exposure, we're deep now in put gamma exposure territory. We're not going to exit that until we trade above 770, 769 specifically, but 770 to be sure. So long as we stay below 769, you will see more selling to come because the puts will outnumber the calls and the market maker is going to follow the feedback. Hence, we see a trade like this with the monthly expiration of September. Mind you, the SPY right now is trading at about 770 apiece. they bought the 730 puts and the 732 puts, so they're expecting a correction in the month of September, maybe leading into September, and they're willing to pay $10 million on that bet. Now, look at the NASDAQ, it's even worse because we're deep into the put gamma territory, and that's not going to change until we trade above 720. So long as we stay below, we're going to continue to see more selling to come because of that pressure from gamma as we see the volume, the open interest, and the momentum for puts buying, outnumbering and outlasting the call volume buying momentum. Furthermore, when you look at the volatility charts, if you look at the risk reversal, you can see that the implied volatility is beginning to pick up in the Qs. And when volatility goes up, that's not good. It means that we're heading closer to a correction. And we see that the put IV to the call IV is actually beginning to recover. So we're beginning to see the implied volatility for the puts versus the calls beginning to improve. So implied volatility is rising higher, and the traders are betting on puts. What does that tell you? It tells you that we're heading into a correction, and the puts right now are cheap if you consider the fact that the implied volatility will go higher, because that's going to appreciate the premiums of these puts. If you see the put IV continuing to opening a gap with the call IV, the blue line will continue to go higher. That means, again, the premiums for these puts will continue to appreciate in value. You can see it here in this Q. So the put IV, the red line, is actually perking up higher, and the call IV is perking down. So this kind of setup leads us to think that we're heading into a correction. And again, the seasonality, end of August, September, these are bearish periods for the stock market. So it all makes sense when you think about it. Where would be the source of weakness in the Qs? The trader here thinks it's going to be the SMH. It's going to be chips. So hyperscalers might underperform, but the majority of the damage will come from chips. They're trading right now at 569. Let's call it 570. The trader bought the 545 puts and the 515 puts with the expiration date of September 4th, 2026. They spent about a little over $33 million on that outcome. So if we look at some technology charts, hyperscalers and the chips, let's try to find how the technicals look for these names. We talked about Apple, right? If we have problems with the chips, if we have problems with the hyperscalers, then if you're a technology investor, if you're managing a tech portfolio, you have no other choice. You have no other alternative, Tina, besides moving the cash to the safest company that is not burning cash flow right now, that is Apple. So the fact that we see Apple moving up higher again above the 50 days moving average, and we see that the MACD is beginning to curve its way to trade higher, as we've seen here. So you can see how it kind of crossed from bearish to bullish. And are we seeing the same thing building up right here in the MACD? That's what the chart suggests right now. You see the RSI kind of perking up. So again, if you continue to see this dynamic in the tug-of-war, well, both of them go together, down together, the hyperscalers and the memory / the chip components, then the money has to migrate back to Apple. And hence today we said that we're going to try a trade here of the 310, 315 call debit spread to the end of the week and see if that's going to, if this theory is validated or not. And if it is, then we can add to the trade, we can add more exposure to Apple. But the point being is, technology investors, some of these portfolio managers are specifically tech managers, and they need to have tech exposure. They can't just take the money and rotate to energy or healthcare. They need to maintain tech exposure, so you have to shuffle the money around. And your choices, memory chips, AI data center stuff with the volatility up and down, you can't rely on that. The hyperscalers with interest rates going up and the level of debt ballooning, you can't rely on that. The software companies, they might look so good right now and maybe they're oversold a little bit, but as they go higher, the case for them becomes weaker. So the only option left here is Apple, folks. If we look at Alphabet, it's below the 50 days moving average, forming a bear flag pattern, lost 350, retested. You see that wick right here, retested 350, couldn't make it. So we have to believe here that Google, Alphabet, is going to head down to the 200 days moving average as it continues to lose momentum, as we see right here. We'll give it the benefit of the doubt. It might try to 350 again, but it looks to me that it's done and it needs to go down, seeking lower support at the 200 days moving average. You see the Microsoft too, so we talked about the rising wedge right here. It honestly went down a little bit, but it needs to close the gap, at least this gap right here, before it finds a legitimate ground for buyers to show up again. So we expect more pulling back in the hyperscalers. If you look at Amazon, they're already pulled back, and Amazon, every time it gaps higher, it kind of fails, as we see in this example right here. And the question is, when you see it here, it kind of rallies, then boom, it comes back down. So are we going to see the same thing where Amazon fails? for now, it is oversold, at least in the hourly chart. For example, it's a little bit oversold, so it could rebound a little bit. But again, whatever rebounds are going to get here, they're probably going to be faded, and we're going to see lower lows to come as this problem continues. If we continue to see higher rates, then expect that the rebounds in hyperscalers will be faded quickly. And then you look at Meta, that's problematic because you have a double whammy. It's not just that rates are going up and they're running out of cash, they're raising an insane amount of debt, they have massive obligations off the balance sheet. It's also the court ruling that we got today, and there's more to come. All of these states suing Meta because of the child endangerment. You can see that in Europe and Australia and many other countries. So now you have supported the trend line in yellow, as I'm illustrating right here. It's an important level of support. We're about to lose that. If we lose that, we have another layer here at 520. But if you lose that, then you have the 200 weeks moving average. But look, we're stretching it. I think if you lose the trend line, you're losing 520 and you're probably going to lose the 200 weeks moving average over time. And we have more downside to come as investors begin to question the stuff that we just explained to you, the Blue Owl, Hyperon, all of that garbage, and the financing and the questions that come with it. Then you look at chips, NVIDIA, again, the hybrid between hyperscalers and chips, and you can see the rising wedge, a reflection of the NASDAQ really, and it's capping down. Don't forget that Mama Cathy Wood bought NVIDIA yesterday, so it's not a surprise to me that we see NVIDIA down about 2.5% today and probably more downside to come. You look at other chips like Intel, we talked about this setup right here, the rising wedge, it's already playing out, and we have maybe supported around 90. If we lose that, then we head down to closing the gap right here, which is going to be right around the 200 days moving average. If you look at even Micron, the strongest of the bunch, plug in your Bollinger Bands, okay, it caught a rebound from extreme lower Bollinger Bands readings all the way to the top again, but now it's coming back down and losing the 50 days moving average. And if we continue to see the same dynamics that we've seen today, then guess what's going to happen? The next retest will be the neckline. If you break the neckline, then we have to retest the lows. If you look at SanDisk, same thing. It gapped above the 50, then lost it. So it caught a major rebound, but it reached the top of the Bollinger Bands, same as Micron. Extreme lows in the Bollinger Bands, then pierced above, and it's over for now. The strongest part of the momentum in the rebound is over and behind us. And hence, today we booked profits from SNXX, gain of about a little over 100%. And we're going to rotate the profits back into SNDQ, which is the bearish ETF for SNDK. Other names worthy of mentioning about SpaceX. Don't forget about the level of debt that SpaceX has on its balance sheet, by the way, and off the balance sheet, because that's another one. And you have higher rates. You do the math here, but from a technical standpoint, we have 150, that's resistance. You trade above, you have more gains to come. Then you have 135 as support, that's the IPO price. You trade below, then you're going to go back to the lows again and have a revisit the 100 at least. So right now, there's no trade for us to do. But if you have a breakout above 150, you know what to do. You're going to buy the reaction right here, so it's going to be the 170 calls. You lose the 135 level of support, then you have to bet for a revisit to the lows here at about 100. And then we have Uber. So today I sold Uber, and the reason is Jim Cramer went bullish on Uber. And honestly, I don't want anything that Jim Cramer is going to hype. So we got out with a tiny little bit of profit, and we'll see what happens here because, yes, there is a case that you could make. Today it's consolidating in a bull flag under the 200 days moving average, and once it trades above, it continues to go higher. Okay, if it does that, I'll buy it again. But right now with the Jim Cramer jinx, I see multiple resistance here and rejections at the 200 days moving average. If that continues, then we're going to head back to the 50. If we don't find buyers in the 50, we go back to 70 again, hence the exit. So what's good? We talked about energy, right? The XLE, that's trading all-time highs. You see pullbacks, you buy them. And then when we talk about healthcare, folks say, what do we buy in healthcare, Mav? Well, I've been guiding you, by the way, in Discord in my purchases in the Maverick portfolio. By the way, if you're not in Discord, consider being in Discord in the VIP tier or Top Gun. You have to upgrade before we get the prices up. Once that happens, it's going to pay the insane prices if you want to upgrade. And those of you who joined us in Discord but having trouble logging in or seeing the Discord page, it could be a cookie-related thing where you have to log off and then log in again and fixes it because it's supposed to be integrated automatically once you have a VIP or Top Gun membership. The other thing I want to note is if you get a message from Maverick, it ain't me. That's the Chinese Maverick, and they're trying to scam you. That's actually the North Korean Maverick. So be careful. I would never, ever, ever message anybody first. Never. But we go back to the topic here. XLE Energy, that's doing pretty good. No problems here. You see pullbacks, you buy them. And you look at this chart right here, it's beautiful. Then when we look at healthcare, I mean, we talked about Gilead. I have Merck. I have a lot of stocks that I shared with you before. But at this stage, if you don't want to guess and just pick the individual names, you can pick an ETF. The problem is the first one that comes to mind in healthcare is the XLV. The problem with the XLV, it looks pretty good right now, but it's heavily weighted by Eli Lilly, J&J, and United Health. These names are overvalued for now. They could come down if we see interest rates going up, for example. They still have debt and all of that, but the rest of healthcare is doing fine. So how do we solve this problem right here? Instead of the XLV, you buy the RSPH, which is the equal weight healthcare. That gives you exposure to all of them without the reliance or the risk of having Eli Lilly and J&J forming 40% of the ETF. And if you want pure big pharma exposure, the majority of the ETFs you're going to find, again, heavily weighted by J&J and Eli Lilly, because those two are the top performers in healthcare. So one way to get around it is to go with the PPH. PPH is big pharma ETF, but if you look at the distribution here, distribution of weight, it's a lot better than the majority of the big pharma ETFs. So you have Eli Lilly about 20%. Again, you're not going to be able to avoid that completely, but you have Merck at about 10%, then NVS at 10%, you have Pfizer at 5%, and you have many other companies. So 20% Eli Lilly, sure. If Eli Lilly goes down, you still got exposure to other companies. So that's one way to consider investing in big pharma right now. And again, if you look at this chart right here, you can argue that we have somewhat of a cup and handle pattern, and we're already breaking above the highs. And lastly, moving on to the conclusion of this video, what do we have in the economic calendar tomorrow? We have the minutes from the Fed meeting last month. It's going to be important again because we have dissent. We want to hear the commentary, the dot plots, etc. That could be market impactful, by the way, because if the dot plots are hawkish, if the comments are hawkish in the minutes, then you're probably going to see interest rates going higher again as the market begins to anticipate Jackson Hole and begins to anticipate the rate decision in September by the Fed. On the earnings calendar, before the bell, we have Target, we have Lowe's, TJ Maxx, Estee Lauder, so we have plenty of companies here with great feedback on the consumer. And Viking is another one for the affluent consumer when it comes to cruises. And after the bell, we have Webull, trading platform. A lot of you, some retail investors are in it, so let's see what it's doing right now. I don't think it's pretty good because a lot of retail investors' portfolio have been blowing up just by, I don't know, Nibius going down 30% and then rebounding higher again. But that drop down 30% blew up a lot of accounts. And again, when you see SanDisk today down 9%, Nibius down 5% plus, believe it or not, these tiny pullbacks in names like CoreWeave and Nibius and SanDisk and whatnot, these little tiny pullbacks are enough to blow up a lot of accounts, a lot of funds, because all of the buying that they're doing is via leverage. You have higher rates now. Anytime a little bit of a pullback, you see more blow-ups to come. So, okay, say folks, we have seen what happened to situational awareness, but that's just the tip of the iceberg. We have many, many more blow-ups to come. They're going to be way larger than situational awareness. And we explain to you why. The level of debt right now in the economy is insane, and as interest rates go higher, that's the recipe to pull the tide out, expose who's been swimming naked. Now with that, folks, we have reached the conclusion of this video. Hope you enjoyed it, got some benefit out of it. But this is all I got for you for now. Thank you for listening. Thank you for watching. I appreciate and I love all of you. I'll be talking to you again tomorrow. Good night.